Hello everyone, hope everyone is doing well. In this video we are going to be talking about 30-year mortgage rates. As mortgage rates are heading down, according to Zillow, the mortgage rates are heading downwards as the labor market is softening. So we'll analyze a little bit more in depth in the backdrop of current economic condition, where the mortgage rates could be heading towards in 2024 and in 2025. Rates are also coming down pretty heavily last couple of weeks. Last CPI prints showing that inflation in United States is coming down to about 2.5%. From all the way up to 9% 2 years ago, and similarly the labor market is also softening. So at this time, currently Federal Reserve is expecting to cut interest rates in their next upcoming meeting on September 18th because Jerome Powell, President, has mentioned that the inflation has slowed down, and labor market also they do not have to wait very long to keep the high interest rates. So at this time, if you look at the CME tracker website, as of yesterday, there's a 50% chance that Fed is going to cut 50 basis points interest rate from current short-term rate around 5.25% to 5.35% rates, around that area. So 25% basis points, 50% chance, and 50 basis points cuts in 50 the probability of 50 probability. This is to be only 33% probability of rate cuts of 50 basis points about a week ago. So the probability has gone up very high during last 1 week. 10-year treasury rates this Friday is at 3.657%, and it is to be almost 5%, coming down quite heavily since it reached around October last year. This 10-year, as and whenever the Fed cuts the rates, short-term rates, it doesn't really affect the mortgage rates directly. The mortgage rate mostly depends on 10-year treasury, and as you can see in this particular graph, that currently for last since 1972, there is a very high correlation in how the mortgage rates, 30-year mortgage rates and 10-year treasury rates follow. If you see in this green, dark green showing mortgage rates, and the one below less green, 10-year treasury, as you can see, these two rates are very highly correlated, and there is basically about 2.9% spread between 10-year treasury and 30-year treasury. It basically swings the peak, the change of peak is the highest peaks here, say in 2009 you could see 2.91% point. It was around 2.65% around 2019 to 2021, and a couple of months ago it is to hit as high as 2.96%. So this is kind of like the range where this 30-year rates and 10-year treasury yield fluctuates. And you can also see the correlation between 10-year treasury and the 30-year treasury. As you can see, they track very close to each other. As of yesterday, the 30-year mortgage rate stands at 6.2% from this Federal Reserve St. Louis website. So these rates had gone up almost like 8% about a month ago, and now steadily coming down to 6.2%. And it is quite expected once the Fed cuts the rates, the 10-year, the short-term rate is going to be cutting down, say 50 basis points in September, and there's going to be another maybe 1 or 2 cuts till the end of the year. And there is a correlation between different short-term rates and long-term rates also. As you can see, how this, there's the correlation between short-term and long-term treasury rates here in United States. Let's look at this yield curve. As of now, this yield curve is showing it's an inverted yield curve. What the yield curve really indicates is that where the interest rates are going to be at different tenor, starting with short term, so it could be at 1 month, 2 months, 3 year, all the way 6 months, 1 year, up to 30 year. As you can see on the left side, the short-term rates are higher, and it's like going down around at the middle, like around 3 year, where I'm showing in this graph, and then around 20 year, the yields are again going going higher. But in a good economy, usually the yield curve should be upward sloping, meaning the 10-year rate, 2-year rates should be smaller than 3-year rates, 5-year rates going higher, should be higher than, and 10-year rates should be higher than 5-year, and 20-year rates, because in a growing economy, if you want to borrow money, the rates you want to borrow for a longer period, you are expected the interest rates are going to be higher. But Federal Reserve is artificially maintaining the short-term rates by keeping the interest rates high. The real rates is around about if the inflation is 2.5%, and if the short-term rate is 5.5%, so there is about 3% rate is higher. So the real rates is a lot higher than where it should be. So once the Fed cuts this rate, they will continue cutting for some period of time, could be in 2025 or maybe in 2026, and the yield curve is going to be then upward sloping instead of inverted slopes. So in this background, if this 10-year rates are also going to come down, and the spread between the 30-year mortgage, as we said, it's in the band of around a low of say 1.3% to 2.96%, we can forecast where the 30-year mortgages are going to be based on where the 10-year mortgages are. So I looked at these forecast rates. Currently it's showing in this particular graph the average rates were studied between the analyst. They says this that 10-year treasury is expected to be at the end of 3.7% at the end of 24, 3.6% in 2025, and 3.6% as well in 2026. And the mortgage rates are going to be going down. It is expected to be around 6.1% at the end of this year, 5.5% in 2025, and 5.4% in 2026. Not too much movement from 2025 to 2026. So according to mortgage rate forecast by the 3 different entities that I looked at, National Association of Realtors, Mortgage Bankers Association, and Fannie Mae. So they think this 30-year mortgage rates should be at the end of the year is going to be, according to the Mortgage Association Realtors, it should be 6.7%. Mortgage Bank Association 6.5%. Fannie Mae, it's a government entity, it's going to be around 6.4% at the end of 2024. And looking beyond, if you look at this particular graph, the 30-year mortgage rates by Fannie Mae, MBA, Mortgage Bankers Association, and Wells Fargo, it shows that the average, like the MBA, the rates are going to be 6.5% in 2024. These three graphs in three different colors, like green, the orange, and the purple color, showing where the 2025 rates are going to be, like 6.95%, 6.1%, 6.3% for these three entities as well. And in 2025 is going to be 5.85% and 6%. So as you can see, the mortgage rates are going to be trending down in the next 2 years. But at the same time, you can probably you cannot expect that you're going to be having 30-year mortgage rate at 3% at any time soon. Although the rates are going to be going down, but it's not going to be going down that low where it used to be, say 2 years ago. Right now the inflation is slowing down. The general economy itself, although it's good, but it's not very robust like it used to be, like last month ago, because the labor market is softening. There were ISM numbers. These numbers also showing there is the manufacturing side of things a little bit slowing down, as well as consumer confidence that also could be impacted if the labor market softens. So with this background, hope you like this video learning about this 30-year mortgage forecast. If you have any questions, please would appreciate your comment, and please hit a like button, and I'd appreciate if you subscribe in this channel, so that I get encouragement to make better videos. Thank you very much, and have a wonderful day.